that the push for nonprofit mergers is rooted in this exact perspective. The belief is if you just consolidate those operating costs, then we'll run more efficiently, as opposed to recognizing that institutions have real operating costs, different cultures, different programs, and I'm just wondering, I guess I'm seeing that despite this recent support, the actual momentum in that within the foundation arena is actually continuing further down the line.
The questioner is just pointing out that there's a lot of momentum in the foundation area, especially in pushing for mergers and combinations of not-for-profits, and that there doesn't seem to be a particularly strong recognition of the fact that organizations may have different cultures, may have different niches that they fill, and those kind of things. I hope I'm paraphrasing what you've said, okay. And I do think, and the reality is that this is a one thing at a time kind of an analysis. And one size does not fit all. That's very true. And but by the same token, there's a lot of people who are saying, wait a minute, 11,000 nonprofits in San Diego County, what's wrong with this picture? So I think like anything else, we really have to all get together and communicate what's happening. And it may very well be that back office collaborations, and I was talking to Jackie a little bit earlier about this, back office collaborations, organizations that might be able to be put together to bundle some of this underneath some kind of an umbrella that could be funded separately, that would be more efficient to service some of these things. But I'm sorry, everybody has to have their own donor management system, right? Yes, Joyce?
Joanne, we're passing out some of the handout materials.
All right, so while you guys are doing that, I'm going to segue on to part 2. People ask me, what does it mean? What's financial management? Okay? And they think, well, it just has to do with the cash account, or just have to do with financial statements and everything else, and nothing could be further than the truth. Okay? So we're going to learn a little bit about financial management in a business. Doesn't matter what kind of business you're in. We're just going to learn about financial management, and then we're going to tweak it a little bit and get specific to the nonprofit space. Okay. This is something that I call the nonprofit management cycle. It actually doesn't even need the word financial. This is a management cycle. This is what we do as managers of an entity. It's what we do as managers of our family. It's what we do as managers of our personal lives. It's what we do as managers of our soccer team. Kind of doesn't matter. This is what we do. We make a plan. We make a budget. We make a report. We see how we're doing against our plan. We make an analysis. We change our mind. We go back and we plan again, right? Kind of a constant thing. You're always sort of tweaking what you're doing. Looks like this in the not-for-profit space. Part of our plan is a development plan. We've already made a plan. We know we're going to serve the homeless or have a food bank or whatever. Now we need a development plan, and Ray shared that with you this morning. We're going to make an expense budget. And then we're going to operate our entity for a while. At some point in time, we're going to have some financial statements that let us know how we're doing and then we're going to look at our other metrics, like how many people have we served, okay? All the different things that we're going to be keeping track of, and again, they're going to vary dramatically from individual organization to individual organization, because it depends what business you're in, okay? Whether it's a financial variance or a physical service number of people served kind of variance, we were trying to get to 50 and we only got to 40. You know, our foster care agencies are always counting how many babies did they place, those kind of things. They have a goal, then they're going to compare how they do according to their goal, whether it was a spending goal or a revenue raising goal or a services rendered goal. You're going to compare that variance. You're going to see what changed. Because how many people have always hit their numbers exactly, okay? You know, you're not doing it right if you, yeah, thank you, Bernie Madoff. That's great. Okay, then we do some financial analysis, because this tells us how the outside world is going to look at us, okay? Because this is a really important piece. We look and see whether or not our plan is working, and we go back to the beginning, okay? Pretty straightforward stuff, but it's something that people forget all the time. So to me, it's so important. I have it on this piece of paper, and as we go through the rest of, excuse me, well, I'll move it later. As we go through the rest of the presentation, you're going to lose this slide. We're going to leave it up here, okay? Because I'm going to keep coming back to it. All right. So here are the responsibilities of whoever is running your financial management in your entity. It could be the board treasurer. It could be the executive director. You could actually have a director of finance. It depends on your organization. Some of these things might be split between people, but at the end of the day, I forget who it was, some famous US president said the buck stops here. Okay? At the end of the day, the buck stops somewhere, and that's the responsibility buck. Okay? Financial control over assets, bookkeeping, accounting, financial reporting, tax compliance is a biggie. How many have seen the new 990? Oh, yeah. The relationship with outside ranking agencies, and yes, Virginia, you can have a relationship with them. Financial and cash flow projections and cash management. My first boss ever, when I went to work as a controller of a publicly traded SEC-listed company, brought a big sticky note in my office, and he stuck it on my computer, and it said, "Cash is king." Cash is king, and he told me that if I remembered that, I would keep my job. And he was right. Operational and outcome reporting, which we've touched on a little bit, cost accounting, HR, payroll, insurance, risk management, banking, legal. These should all look pretty familiar. Weren't they on that other slide that we already talked about? Okay. So typically, your CFO financial, this all kind of tends to get dumped in that person's lap, right? So when you go to hire somebody to run this part of your entity, you need to make sure that they not only know debits and credits, although sometimes it would be nice if they even knew debits and credits, to be honest, but they also need to have some ability to function in all of these various and very different areas. It's a big responsibility. That's why CFOs are, up there with the CEOs and the CEOs, because they have a huge responsibility to the shareholders and to the rest of the organizations, to the employees and to the stakeholders out in the community. Okay? Very important job. How many of you have a part-time bookkeeper with no accounting background keeping your records? Nobody? Wow. Okay, I'm feeling better now. Okay. This is going to be our segue into something that's very important, and this speaks to one of the handouts I gave you today called the SAS 112 checklist. Okay? Not all of you are going to be large enough to be audited, but all of you are probably would like to be. Okay? And if you're in California, that's $1 million. Okay? If you have $1 million budget, you're required to have an external audit. If you have government contracts, you generally are going to need to have an audit, even if it's what they call a single payer audit or a yellow book audit. Anybody heard any of those kind of buzzwords? Lisa, you're nodding your head. Okay. Where the government says, well, I'm giving you money, so I need an audit just on the part of that money. It's called a single payer audit. You don't audit the whole thing, you just audit that grant. Happens a lot. Okay. But internal financial controls are a huge, big deal. Okay. And here's what internal financial controls are all about. First of all, we're safeguarding the assets of the organization. And in non-profits, it's even more important than in regular businesses. Why? Because they're not our assets. They're the assets of the public. We have a fiduciary obligation to the public as a whole, to the people in general. Okay? We don't have any ownership. We are owned by us, right? So the fiduciary responsibility and the protection of assets is critical. Another purpose of internal financial controls is ensuring that financial reporting is accurate and timely and therefore useful. Ensuring compliance with governmental regulations and fiduciary obligations. Okay, you've got to send that report to Jerry Brown every year, right? You've got all these governmental things. You've got 990s. You've got all kinds of issues to deal with. And if you've got government funding in any way, shape, or form, it's exponentially increased. Every time you sign that grant application, you're agreeing to all of this. We're ensuring compliance with grantor and donor requirements. Ray told you. Parker Foundation, giving away $1.5 million, $2 million a year. You don't get those reports in on time, you go to the bottom of the stack on your re-up, right? Okay? The only thing that's worse is sending reports that are wrong. Okay? Truthfully. Obviously, since Enron, and all of the other things that happened back in the early 2000s and resulting what we call Sarbanes-Oxley legislation, the American Red Cross debacle back of 2002 or so, who wants to be on the front page? Well, I want to be on the front page, but not for that. Okay, so that's what internal controls are all about. So popping over here real quick,